Welcome to the Cashflow Hustle Podcast, the show providing listeners with massive value through guidance, tips, and stories from a broad spectrum of active entrepreneurs and thought leaders in the real estate, business, financial, and personal improvement arenas. If you find yourself on the journey to financial freedom and independence and are looking to get out and stay out of the rat race, then buckle in as we take a deep dive to help you achieve the life of abundance and fulfillment that is rightfully yours. And now, here's your host and fellow Cashflow hustler, Justin Grimes.
Hey there, fellow Cashflow hustlers. This is your host, Justin Grimes. I appreciate you tuning into the show today as we explore actionable tips and stories aimed at creating cash flow and ultimately leading to wealth and a more fulfilling life. With us today is Rob Beardsley. Rob, how are you, man?
I'm doing really well. Thanks for having me.
Yeah, absolutely. Appreciate you coming on here this morning early for us as we record this, but it's going to be a good conversation. So real quick bio on Rob. He has acquired $40 million of value-add multifamily real estate as founder and principal of the Lone Star Capital Group, a New York City-based private equity firm. He has underwritten more than 750 deals and has published over 40 articles about underwriting, capital structure, acquisition strategies, and capital markets. And I enjoy a lot of the stuff that Rob puts out. I appreciate him taking the time to do that. So happy to have him on today. Anything I left out of your bio that you want to share with the listeners?
No, that's perfect. Early morning cash flow hustlers, like you said.
Yeah. Awesome. All right. Well, let's talk a little bit about, I guess, how you got started out in real estate in particularly. Is it just a newfound thing or were you born into it?
A little bit of both. I grew up in a real estate household, and so I was around real estate my whole life, but it was on mostly the single family side and then on the construction, development, and sales of a single family. So I was around it, but not where I wanted to be or not where I wanted to end up, because I saw, reading Rich Dad Poor Dad when I was young and getting involved in that culture of passive income, wealth creation, and things like that. That's what really pushed me towards commercial multifamily and focusing on building portfolios rather than trying to, flip for profit or just, run a business type of thing.
So for those out there, we talk a lot about it on the show, but one of the fundamental differences between the commercial real estate space, multifamily in particular, and the single family is, in essence, you're creating when you're in the single family space, it's one door at a time. And it's, for lack of a better phrase, perhaps, you're creating a job when you're flipping a property or when you're wholesaling or anything like that. And it's certainly not that multifamily doesn't require work, but it just allows you to scale a lot more efficiently. Yeah.
Yep.
Absolutely. So on the, let's talk a little bit about, I guess your experience in underwriting and, just the fundamentals of the finance component. You seem to be very well versed in that stuff. Is that a passion of yours? Did you go to school for that, or is something you learned on as you went?
Yeah, it is definitely a passion of mine. And I started focusing on underwriting pretty much from the very beginning. I've always been gravitated towards numbers and spreadsheets, and I studied computer science in college. And when I first started underwriting deals, I figured, I'll just go on Google and search, best multifamily underwriting model, and I'll just download it and start underwriting. It's easy. And I remember very clearly my dad saying, no way, you're going to build your own model. And at the time, it made no sense. I thought, why would I recreate the wheel? That's just such a waste of time. There's already good models out there, I'm sure of it. Well, I later came to find out there really weren't such great models out there. And turns out that building my own was one of the best things I could have ever done for myself, because that was a great learning experience to actually put all the pieces together, which, forces you to really understand how the balance sheet works, how the P&L works, and how all the numbers intertwine with each other, and what are the sensitive assumptions and what drives a model. So I think that was a really great learning experience, and part of the reason why I've seen so much, or why I've learned so much in the underwriting space.
Yeah, absolutely. Yeah, nothing like rolling up your sleeves and doing it yourself. Yeah, rather than just plugging numbers into something that's already built and spitting out an answer that you don't understand why.
Exactly.
Yeah.
Right. You can really, I mean, no matter what model you're using, not everybody builds their own. You should at least understand how it's constructed and, why it's returning what it's returning.
So if you adjust this key metric here and it spits out a higher or lower answer than you were expecting, then try and understand how that's related to other pieces of data.
Yep.
Nice.
Definitely.
Okay. Yeah. Those, on that note, a lot of time goes into those proprietary models that have been developed and stuff like that. So, yeah, I'm sure a lot of hard work has gone into that for you. So let's talk a little bit about something that you focus in both markets. I mean, I've seen some of your stuff is in some of the major MSAs and some of it is in the secondary or tertiary markets. Can you kind of walk us through fundamentally the difference between those first?
Yeah, that's great. So just to put the definitions out there, a primary market would be, one of the major 24-hour cities, and then maybe some of the smaller 18-hour cities, but that would be New York City, LA, San Francisco. Those would be the top primary markets, and then tier one secondary markets, which are now kind of booming and becoming primary markets, would be Dallas, Fort Worth, Houston, Atlanta. So those are traditionally or typically secondary, but now everything's kind of getting pushed, and people want to always be investing in primary, so they'll just put that into the primary category. And then some things that were typically tertiary now were late cycle, so now it kind of becomes a little more secondary. But yeah, you're right. We focus on primary Texas markets and tertiary markets throughout Texas. So we buy into the Texas boom, and we see no reason that boom shouldn't benefit the small cities as well as the larger ones. So I think where we're headed in this discussion is talking about finding potential value in places where other people may not be looking.
Yeah, absolutely. A lot of my, investors that I talk to, as well as other operators, they're involved in those major, statistical cities. Yeah, how did you kind of settle on, or how did you begin to explore the value of those tertiary markets?
Just by looking at deal flow, and I've looked at so many deals in DFW. I've looked at so many deals in Houston. I've looked at some deals in Austin and San Antonio, and it's pretty much the same story with each of those. We have gravitated a bit more to Houston because we've come to understand that market and find that it's a bit better priced, but nonetheless, it's still super competitive. And and then we get the odd deal in a smaller market, like a Lubbock, like a Tyler, and just the smaller cities around Texas. And maybe they're still not great deals, but sometimes they're a bit more attractive. And just because they're not as competitive markets, there's maybe an opportunity to not be in a 20-person bidding war for a 1970s construction, garden style apartment.
Yeah.
In
So
DFW.
yeah, there's certainly going to be a lot of competition in that space right now. A lot of bids on the table. So, one of the key components that we touched on is the underwriting of those deals. Can you kind of walk through some of the differences in how you might underwrite tertiary versus a major market?
Yes, I think typically the big difference is going to be the going in yield or your cap rate, right? Which that's kind of, for some people, that's a really important metric. And as they're looking at different deals, they might look at a tertiary market and they'll see a deal in the middle of nowhere for an 8 cap and think, oh my gosh, this is a great deal. But the problem is cap rates have consensus growth assumptions embedded in them. So, if you quickly break down what a cap rate is, a cap rate starts out as a risk-free rate, which would be, U.S. Treasury bonds. And then on top of that, you have the real estate premium, real estate risk premium, illiquidity premium. And then you also have subtracted by growth assumptions, right? You'll pay a lower cap rate today if you think a market's going to grow, a lot over the next 5 years. So that assumption, what the market thinks about, or what the general market view is about the growth, it's factored into the cap rate. So just because you can buy an 8 cap in the middle of nowhere doesn't make it a good deal. So I think when you're underwriting, you have to adjust your growth assumptions accordingly, and basically rely less on appreciation and more on in-place factors contributing to the underwriting, which I think is fundamentally different, especially this late in the cycle where you're seeing a lot of deals. The only way for a primary market deal to make sense right now is if you continue to assume crazy growth and low cap rates, which they might happen, but being where we are in the cycle, it's, for me at least, very hard to get comfortable with those assumptions. And in the meantime, what are you left with? You're not necessarily feeling comfortable sitting at a 5 or 6% cash on cash return, waiting for a big appreciation to happen. So I think that's the difference, where when you're buying into a tertiary market, you really need to be comfortable with the in-place returns that day. And, typically we're value add buyers, so we're still looking for that lift. But you're not going to see as much of an appreciation play there.
Yeah. So on something like that, you'll be, throwing numbers out there. It's a city under 100,000 people. I don't know. We're working on a deal right now. It's under 50, so it's not somewhere that necessarily there's huge job growth. There's not huge population growth. However, there is stability. When you look back historically, it's just kind of, it's there and it does what it does. Yeah. There's not a lot of volatility in it up or down.
Yeah, exactly. And, maybe not all small markets have those characteristics, but I think looking for those small markets today that are the steady ones, that if you have data, if you have access to data, you can look back and see how it fared in the last recession. You can see, a lot of those markets just held steady. Their cap rates held steady. There wasn't rent growth there anyway, much. So it didn't really matter if rent stayed flat, because that's what they do most of the time anyway. So, to your point, with that, you're not going to see crazy job growth. But if you have a stable, diverse employment base, just like you're looking for in a primary market, you should be fairly protected on the downside.
Right. Let's, as far as the returns in those types of markets at this point in the cycle, and maybe even previous to where we're at, what would be the typical differences in the returns that you could expect?
Yeah. So the one people call, let's say, in ordinary times, you're buying good deals in primary, secondary markets, and you're getting an X amount of return. Let's call it a 15% IRR, just to put a number on it. And then the deals start getting tough and they start getting more competitive. And then people say, oh, you know what? I'll just go and get that same 15% return in a tertiary market. And I'll go to that small, and that would be considered reaching for yield. And that is where the problem occurs, because people think, oh, I'm just pivoting and I'll just go and get that same return elsewhere. But you actually need to demand a risk premium for going to that smaller market. So, if you could get a 15 in a certain market, in a more major market, you should probably look for a 16, 17% return in a tertiary market. And then the other part of that too is you should see a lot more of your return come out of cash flows rather than appreciation in a tertiary market. Like you said, it's steady. It should just pump out cash and then not see a huge windfall on the sale. Whereas in a primary market or a growth market, you're going to see smaller cash flows going in, and they'll build up into a bigger sale number. So I think those are the big differences. Okay.
As far as entering or selecting, I guess, some of these smaller secondary, tertiary markets that you've invested in. Can you kind of walk through not necessarily the process of selecting, but building out your team? So, there's not maybe as much, or my assumption is there's not quite as many property management companies that are interested in those smaller markets and different things like that. So it's a little bit of a different challenge. Can you walk through maybe some of those components?
Yeah, it's definitely a big challenge. How do you get to these smaller markets? And so, we've been fortunate enough to have a DFW-based property management partner. And, for the most part, they are willing to accommodate us looking at smaller markets, and they themselves are interested in smaller markets. And I think a good way to overcome that challenge is to try to buy and scale. It makes a management company a whole lot more comfortable going to a new market, especially a small market, if you're going in with some scale. So I don't know exactly what that number is, and I'm sure different companies are different, but if you can go in and amass a portfolio of, 500, 1,000 units in a small tertiary market and kind of control that little local market, that puts you in a very strong position. And I'm sure your management company at that point is happy to be out there.
Sure. And that's something we chatted a little bit prior to the call, but you guys have done that in a Texas market where you've bought a property, and now you've bought an adjacent property to that as well. So you guys are executing exactly in that type of manner. Yeah.
Yeah. We haven't fully rolled that whole platform out, but something that we realized was, once we're getting comfortable with a small market, it doesn't make sense to duplicate that effort for every single market. Once you get comfortable and you've done that due diligence on a certain market, you might as well go and really try to find more acquisitions there. Because for one reason, that way you can, save on the due diligence efforts on other markets. And then number two, you're building out that scale that we just talked about.
Right. Okay. Let's see here. So one of the things wanted to talk a little bit about is from an investor perspective, when you're visiting or going over a deal on those tertiary markets, what are some common rebuttals that you might get, and how might you respond to that?
Yeah. So a lot of people talk about tertiary markets and they say, well, maybe they're doing okay now, but in a recession, there's not a deep enough job base there, and it's all going to collapse. And that's why, just as people look for certain employment metrics and employment diversity in primary markets, you should be looking for those same metrics in a small market as well. And basically what people are saying is you're going to lose occupancy, or your rents are going to go down, and you're going to then have a harder time paying your mortgage. So, but the difference is, in a primary market, you're looking at, depending on how you're leveraged, traditionally, for example, Fannie Mae, Freddie Mac are going to hold you to a 1.25x coverage ratio. So on paying principal and interest, that means your NOI is 125% of your mortgage. So what that roughly means is you could experience a 20% decline in NOI and still be able to pay your mortgage, which is a pretty reasonable cushion, right? That's what all the banks are mandating. So it seems to be that's a good number. Mm-hmm. But you'll see a lot of lenders push and ask for a lot more coverage in smaller markets. So it's harder to, all else being equal, it's harder to over-lever yourself in a tertiary market, because you might have a lender that says, well, in this market, I need a little more cushion in case cash flows deteriorate. So instead of a 1.25x cover, we're going to need a 1.4 or 1.45x. And oftentimes, if you're buying right in these smaller markets without even the lender requiring it, you could still get max leverage, meaning 75 or 80% leverage, and you'll still be above a 1.4. So like you're asking about my rebuttal. My rebuttal would be, look, our downside protection, the amount of revenue or income we'd have to lose and still be able to break even and pay the mortgage, is a lot bigger of a cushion than the the way deals are leveraged typically in primary markets.
Yep. And then looking back historically, maybe at as a piece of data at least, how that market performed on vacancy rates in the previous recession. That may tell you, I guess, a component of what your where you may reach in another recession, or at least it's a data point.
Absolutely. Yeah. I mean, not all recessions are the same, but that's certainly a question that investors ask and gets them really comfortable if you're able to provide that data.
Yep.
Which, speaking of data, we kind of discussed this offline, but I know you mentioned it's a little bit trickier to find data in smaller markets, and that's absolutely true. You don't have these big glossy brochures from CBRE or Berkadia on, Lufkin or something.
Yep.
So, but at the same time, technology has really come a long way. Specifically, data has come a long way. And I recently wrote an article where I cited a CCIM report where they are mentioning all these new data service providers that are really able to shine light on pretty much everywhere, including the tertiary markets, which they cited that as being why the real estate finance market has been able to grow so much, because lenders were able to access more markets and get comfortable, given the data they have, to lend in more markets, right? Typically, I don't know how it was 40 years ago, but I'm assuming it might have been a situation where a New York-based lender would really only know the New York market and only feel comfortable lending in a major way in New York. Mm-hmm. And now I think most lenders are able to get comfortable in most geographies.
Yep, absolutely. One other question I wanted to ask before we shift gears, an important part of growth is setting goals, planning, executing, things like that. Are there any particular goals that you have set out at this point? I know you guys are taking on some additional projects. Do you guys have some things that y'all are shooting for, aiming towards?
Yeah, the goal that I've had in my head for, I can't remember when I first said it, but it might have been about a year and a half ago. And it was to hit 100 million assets under management by May of 2020. So that's kind of the goal I've been putting out there. So, I don't know who's going to reach out to me on May of 2020 and say, hey, did that happen? But I'll be trying to hold myself accountable.
I'll set a calendar reminder.
There you go.
All right, cool, man. Let's pivot here and go to the cash flow hustle round. Are you ready for that?
Yes, sir.
All right, let's do it, man. First, a word from our sponsors. Hey there, everyone. I wanted to invite any listeners to get in touch if you're interested in learning more about how to get involved in online businesses or passive real estate investing. With over 1,300 apartment units, a few hundred self-storage units, as well as mobile living parks, and 4 online businesses, I'm actively operating and researching deals daily. I'd love to chat about any opportunities that you see or questions that you may have. Please go to timbermosscapital.com and schedule some time to visit. Thanks, and now for the show. What is your favorite resource, book, podcast, or other that you have found useful on your cash flow hustle journey to date?
Yeah, so the people that know me will know I talk about this resource too much, but definitely Howard Marx's memos throughout the last few decades. Howard Marx is the co-founder of Oak Tree Capital. They now do real estate, but they're not really that big in real estate. But he just has great commentary, writing quarterly memos dating back to 1990, and I've read every single memo, which is over 100. And so seeing he's an economics genius, and seeing his insight from 1990 to today, he just put out a memo last month, is such a great way to basically gain all of that historical experience, and download it to your brain.
That's pretty cool. Is that a just something that you sign up for, or like a paid subscription, or
you just oaktree.com and Howard Marx's insights, and they're all there.
That's cool, man. Nice. That's interesting. Is that something you're obviously very passionate about? That stuff, your background research, you seem to really dig into this stuff. You don't just skim the surface.
Right. Yeah. We try to be second level thinkers and not just take what the broker's telling us at face value.
Yep, absolutely. Okay. If you could give yourself one piece of advice as you began your journey in the space that you're in right now, what might that be?
So I've got a couple. So the cliche one is whether you think you can or can't, you're right. That's kind of the inspirational one. But then the brass tacks is when getting started, I think it's really valuable to dive deep into one area of the business. And that's probably true for any business or venture, but really getting involved on asset management, acquisitions, underwriting, capital markets, financing, whatever that is. I think diving deep into one expertise is very valuable, and it can carry you into developing into a more broad role. But I think starting out somewhere narrow is really helpful. And then the other one, which is also kind of a cliche, but the due diligence, and that's due diligence on everything. And I'm not a fan of due diligence, but I've learned the hard way, the easy way, every way, that due diligence is absolutely key. And that means due diligence on partners, on property management companies, on deals, on markets. It's just work.
Yep. Awesome. Yeah. Great advice. 3 pieces of advice too. Thank you. Good bang for our buck there. Last thing I got is, how can the Cashflow Hustler listeners get in touch with you here moving forward?
So you can check us out at lonestarcapgroup.com, and you can reach out to me directly. My email is rob@lonestarcapgroup.com. If you want to connect about co-investing, if you want to connect on my underwriting model, happy to share it. Happy to help you on your journey.
Awesome, man. I appreciate that. Yeah, that's a tremendous gift. Yeah, for you to offer to share any of that stuff. So appreciate you coming on the show here this morning and sharing a bit about your journey and how you guys are executing right now, the current place in the market, and looking forward to staying in touch and watching you guys continue to succeed, man.
Thanks a lot. Yeah, thanks for having me.
Absolutely. We'll talk soon. Thanks, man. Bye.
Thank you for joining us on this episode of the Cashflow Hustle. Don't forget to subscribe and leave a review on iTunes, Google Play, or the listening platform of your choice. Also, please check out the cashflowhustle.com, find us on Facebook, or reach out on Twitter at CashflowHustler for more useful content to help you on your journey to financial freedom. Until next week, embrace the journey.